Welcome in to the crypto bunker. It's been a little bit of time here, guys, and just wanted to do a check-in, just in case anyone has been wondering. Um, just been really busy at work and haven't really been able to get around to creating a video. And also, it's just been sort of boring. I posted a lot on Twitter uh, about how I feel most of the times. I do charts here and there. So you can follow me at crypto underscore bunker on Twitter. So this is the stock market for the US. This is the S&P 500, and we see that we are closing these daily candles or weekly candles, which is more important, above the 200 week moving average. And this is a very key inflection point. So that's why I wanted to jump on here, because in previous times of stress, we have um, usually used the 200 as support. And this one obviously went straight through because of it was sort of an unknown situation. And then we printed even more money. And that's kind of where this came from, was just the the Federal Reserve basically having your back guaranteed. And every single time it hit this 20-week, it caught support until here when it failed, and then it tested, it failed again, and since then we've tested it a few times and failed again. I wouldn't doubt that we could come up and test it here and go to around 3,900, but I also wouldn't doubt that we could, chop. And what I think will sort of happen is that we will go into this ascending wedge that is sort of sideways action. And I can show you sort of why I think that, because this is what happened in 2008, 2000, which I think is where we're headed. But it would sort of just kind of flat be this what you call a ascending wedge after a correction, which is usually bad. And then we're sort of hanging out here, and then we really take the tumble down to um, you know, maybe around 3,000, something like that. Um, and if you can see in 2008, this is sort of where I think we could be, because again, this is where we lost the 200 week. And that's very important, because when you lose the 200, bad things can happen. And as you can see, we lost the 200, and then we formed this um, ascending wedge here, and then we tested up here, and we sort of tested that 200 week, and then we fell. So we haven't really like fully broken it yet. I would say we're just kind of hovering right around here now. And what we could see is just a crash through, and then you would look for a retest and a failure before the real crash. And I think that that will take some time. I wouldn't be surprised if we go through a few more months here of just, like I said, just kind of sideways action. We can see in 2000 what happened. What happened here was sort of similar. We lost the 200, came back, sort of formed this ascending wedge, and then crashed down. This one was more played out. It just continued to crash down. It wasn't just like one big crash. This was when the markets were a little bit more organic, I guess you could say. And in 2008 is when the intervention really was created, and the monster was created to basically inflate our way all the way up until, as you can see, where we're at now. And it was funny because the other day or yesterday, I tweeted at Raoul Pal and said, markets will never go back to all-time highs. The Fed supported us all the way from 2009 to here, and now they're not supporting us, and we have inflation. And he just laughed at me. And it's kind of funny to get his response on there. But I think that what we're looking at is a 2000 type bust. This is even more parabolic, as you can see, than 2000. So it's just so far beyond. Um, and obviously, like with the stock market, the thing that people I guess, forget is that yes, they do take out bad companies and they put in better companies, or they put in the top 500 market caps of companies. And so um, it is important to know that it's not going to come like all the way back down, I don't think, but because it's just, again, there's just been more companies added in and everything. But I wouldn't be surprised to test the COVID lows. Like if you want to say, okay, worst case scenario, yeah, worst case scenario is the COVID lows around 23 to 2400. And it sounds crazy now, but again, this is the Fed has never raised interest rates into a recession. By this time, usually they are now cutting. And what people don't understand is that the Fed actually cut interest rates before this crash. So the Fed was cutting before this crash. Okay. Same here. They were cutting before the final crash. So if people think, and everyone thinks essentially, except maybe Keith McCullough, who I listened to on Hedge Eye, who has mentioned this, um, when they cut interest rates again, people are going to rush, go long, and they're going to get wiped out because what the Fed is admitting at that point is that we've gone too far. The economy's in big trouble, and we now have to cut because of how much trouble the economy's in. And so it's actually a sell signal in the short term. Longer term, it might be a buy signal, but um, right now, we were sort of in a period of what you would say from about 87 to here was exactly the same gains as from this low to this high. Same exact percentage gains. And so what I think we're in for is a 2000 to 2011, so 11 years, maybe 2033, if we live in, ordinary times, which we don't. So, who knows? But and this is depressing. I mean, I understand, but it's possible that we just do this and then we retest and then we come back down and we don't actually break those 2000 highs until that time. So, um, what that would look like potentially, um, would be something like that, where we don't actually break out until, obviously, like I said, very um, long way away. Um, that is, if the economy, I do think the economy is going to go into a longer, sort of deeper recession. There's people who think that we won't. Um, and, I'll just kind of keep talking about why I think gold and silver will do well in this period. And um, what I think we'll probably see is, and what I'm looking at here is a longer term wedge. So from about 2006, and we have the touch points and we have the touch points here, and this is an ascending wedge, but it's a longer term one. So a lot of people, they think, oh, ascending wedge is going to go down. But a lot of times these longer term ones will actually tend to pop out the top. And so that's where I think we're headed. I think we could test these lows now around 1500, um, something like that. And then we kind of bounce along this line for a little bit. And I'm not saying it's going to take that long, but I'm just saying bounce along the line, work our way back up. And so, it could take a little bit longer. We're pretty damaged here. Um, in terms of the 200 week, we usually don't lose the 200 week unless we're going into a bear market. So, um, we haven't really lost it in a bull before. Even down in 2008, this was the bottom, and we did not. We basically used it as support. The last time something looked like this for gold, at least, was around this time when we lost the 200 week, and then we obviously went through this bear market of just chopping, but it was sort of an upward trajectory. And so I think it could sort of be that way, where we just kind of go down and then we kind of just chop until we can, recover again and make our way out of this wedge. And then I think eventually we'll see big things. But The physical market obviously is on fire, so this could be the bottom right here. And in fact, I think it might be. I'm not saying it is, but I am looking at here if we can hold this level, potentially like a scenario where we chop along this line and then we make a steeper trend line and we go back up eventually. Um, Same with silver. We are sort of holding that line on this recent sell-off, which is obviously complete manipulation with the, U.S. government complying to this manipulation. So, the idea of silver really is to hold physical silver, because in the end there won't be a price because we're gonna eventually break the system that they use to rig the price of metals, because we know that the physical price of metal is like $24 an ounce. So there's a total disconnect, and there has been really since the um, 2021 squeeze in February around this level where we got rejected at 30 again, and they fixed it down. And ever since then, they've sort of just been um, on extreme watch to be fixing it. And this is essentially where all the people have accumulated, including myself. I mean, I accumulated since back here, but a lot of people since the silver squeeze have just been steadily accumulating physical. And so the average price really, if you think about it, um for retail, people that have just been, we're just in this range. So with premiums, you could say the average price is probably around $28. And so that's kind of where I think a lot of people will try to get out, actually, once we get there. Um, but if we break 22, if we break this level at 22.5, um, we'll definitely test this, and then we'll sort of break up to 28. But that, right now what we're focused on is here. And so what I wanted to show also is that anytime that silver, that the 20-day has crossed um, below uh, below the anytime the 20-day it goes opposite here. So we have to say that in these scenarios here, um, let's see if we're looking at the weekly averages actually for this. Yeah, yeah. So anytime the 20 week crosses the 200 week, which obviously is very rare because that's just saying it's just a massive short-term sell-off where you should buy the dip. Um, Anytime that happens, we have a buying opportunity, going back basically every time that's happened, except one, and that was here where we experienced a massive bear market, which I don't think will happen considering that silver is needed for so many things with clean energy, and that's the direction they want to take us. It might not work out for them, but either way, silver is, just a good thing to hold. It's a physical item, um, where you are in control, you are in possession of your wealth, and it's like forced savings a little bit as well. Um, Check out that guy. These are stackables. They're pretty sweet from Scottsdale Mint. But what we can say is that these three times, basically this time was the bottom, this time, and then we just had it. I believe we just had it now. Yeah, we just had it there, and that was, right at the bottom. Potentially. So hopefully the 1750 is the bottom. We obviously could retest at any time. Um, I did say actually that because we broke out here on silver, if we look at it from at least back here, we did well, we barely didn't actually, but because usually when you break out, you want to retest that bottom and then you buy. So I do think that this is a really good time to buy, no doubt about it. In terms of Ethereum, excuse my lines, I know, but um these are important. I mean, usually my lines are really good, and they get hit a lot. So I don't like to take them down most of the time. So right now we're just in a trading range here. Obviously, I called for the 1280 a long time ago, and hopefully, I was basically calling for 1280 all the way from here, like from here to yeah, just here essentially. So it was a long time, but it happened, and obviously we're here 1280 right when we're recording. So it's looking very weak. We're closing below the 20-day moving average. It's very bad, and it's a flat bottom. And so I do think we'll fall down to this wedge support, which will be around 1,050. That's probably where we're headed next. If we break that, or if we sort of mess around there and then go down to a lower low, I think that's probably the ultimate bottom. I did draw this line from here through these lines and through that line as well. And I think that this would sort of fake everyone out potentially, just like we had a lower low here where everyone sort of thought, okay, it's over, but that was actually time to buy. So if we have a slightly lower low, which ironically is what we're having in the stock market right now, and I mean, who knows, maybe that's a potential buy, I don't know. But and obviously I have this key level of like 450, which 434, which is a very key level going back many years. And so, that's worst case scenario, I think. But um, we could also double bottom, but I think potentially we could just hit sort of a very much like slightly lower low around 750. I'm not saying that that's just going to happen. We could obviously breakout right now, really. I mean, it could be, and we could rally up into the 200-day again. Um, don't rule that out. That's coming down here, so probably 1,600, something like that, 1,550. Don't rule that out, but I'm saying that more probabilistically, we go down and we either double bottom around 1,000, or we come down and touch like maybe 670, something like that. Um, and so we've gone through a few things. I do want to say, like, anyone who's in bonds right now in their retirement account, and most people don't really know what they're in, or they have someone manage it for them, who doesn't know, what they're doing. And they have the qualifications, but they don't have the depth um, of knowledge. They more have the memorization of what they went through in school, and they might have, what their company trained them to do, which is just sell the product, in certain scenarios, and basically 60%, the 60/40, right? 60% stocks and 40% bonds, or whatever it is, or 40% stocks, 60% bonds, has underperformed. And this is the 20-year Treasury bond ETF. And so if you hold bonds, you're screwed. And I've actually been trying to buy the dip in a retirement account that I manage, and I've basically I sold this bottom, at least partially, and I'm hoping we can get some kind of rally so that I can sell the rest of it, because this is just a broken market at this point, and people should be very, very concerned. And this doesn't happen like in bonds, right? I mean, even in 2008, bonds got picked up pretty much. I mean, it wasn't like, and ironically, we probably are on this, like, maybe we're like through this trend line at this point. And so it's crazy. And the reason that that's happening, obviously, is treasury yields, I should say, have just gone ballistic. And so what the treasury yield is saying is that inflation is very concerning. Um, and it's saying that this is the Fed tightening. And this is the Fed, everyone's selling bonds, right? We have the Federal Reserve, we have pension funds from across the pond who are insolvent, and they need they need liquidity, they need dollars, right? So what they sell is US Treasuries, because the liquidity usually is good with US Treasuries and dollars. But right now it's terrible. And so this is bad for all asset markets, and really this is the entire reason of the sell-off. If you want to know when ETH is a good buy again, you can just look at the 10-year because as I covered before, um, the 10-year is usually the opposite of what ETH is doing. And so um, when the treasury topped is actually was a really good buying point for ETH. And that's when we bottomed in the original bear market. Obviously, 2020 happened and that, threw everything off. But the original market bottom was the 10-year top here. And so we're holding up pretty well so far, actually, for how crazy this has gotten. Um, I think at this point, we're looking at, I mean, this is essentially a blow off top. And I do think that we've gone far enough away from the 20-week that we are due for some type of sell off, which again would be a rally usually, eventually. But because we're going into a recession, last time we weren't, right? 2018, we weren't going into a recession. Now we are. So it's very complicated. Um, but this is another thing to look at for gold and silver is the 10-year treasury yield, because gold competes with real rates. And so real rates are inflation minus 10-year rates. So if you take the inflation, which is 8%, minus 4%, you have a 4%, negative 4% real carry yield on your money, essentially on your bond. So that's why bonds are selling off because people don't want to take that risk. People don't want to hold it during this inflationary time, which ironically is why the dollar is going up because people are just so scared. They're just running to anything. I do think it's possible that the dollar has double topped here. So a lot of crazy things are happening. This is actually the British pound, which is their currency, complete sell-off. This is a huge deal in the macro world of macro markets here. We also have oil, which is I actually bought the dip in oil in the retirement account, and I will probably buy again and maybe this time look to around 69 of this level down here, which is around probably the 200 week at that point. So maybe, end of the year, something like that. We could see that and that means inflation will come down. And so that means rates will probably have to come down, but we'll be in a recession. And so that's when gold, I think, will outperform, really, is when we see the pivot. Like I said, stocks go down. When the Fed pivots, gold goes up because the Fed pivoting is saying the economy's bad and we have to lower rates. And when they do that, that's when gold outperforms. And so that's why I think in the next 2 years, heading into like late 2024, we see the final blow off top for gold, in my opinion. Obviously, we could go through a bear market. We're very teetering on the edge here, but I'm still obviously accumulating gold and silver. So those are my big plays. Obviously, I still have the staked ETH. Um, I'm looking for lower ETH to get involved. I think just be patient, just through any rally at this point, you have to know that I think we're at least going to retest the lows, whether that's now or 6 months from now. So look out for that. Hopefully you guys got something out of the video. If you did, please like, subscribe, and have a great rest of your weekend.